Hi Clayton, this is Jack speaking from Dallas. I'm acquiring two properties to your company. My question is, as you have mentioned several times, that investors can write off property depreciation. Based on my research, only professional real estate investors are allowed to write off property depreciation. Since we are starting off as a new investor, how can we take an advantage of those write-offs? Thank you.
Great question, Jag. So let me just repeat your question. You're talking about depreciation and writing off these things from a property's perspective. And congratulations, you're working with our company to acquire two properties. That's great. So number one, I would just speak with our team members about that. So because they're going to know your situation better than I will, and they're going to be, if you're buying two properties from us, then our team has been working with you on that. So I would specifically dive in a little bit deeper on that. But I would also make sure that you've got a great real estate accountant. This is very, very important. If you don't have an accountant, okay, a CPA that understands real estate, it's time to go shopping for another real estate investor. On our website, we've got a lower your taxes tab. Okay, there's a reason it's there, because we work with the team from Wealthability. They are amazing. They set up an entire tax team just for our clients at Morris Invest. Okay. And they go from pricey to not as pricey, and in a range depending on where you are in that financial cycle, where you are in your investing journey. So don't be put off by thinking, oh, they're a very expensive tax team. They're not, especially if you don't need as many of their services if you're just getting started, Jag. So I would speak with them. Number one, yes, you're going to be able to, if it's new construction, okay, and you are a real estate professional, there's a couple of things to think about here. If you're not familiar with what that means, a real estate professional means that you qualify with the IRS. That is your primary job, okay, as a real estate professional. Now, you cannot have another full-time job and qualify as a real estate professional. This has to be your primary income. Okay, or not primary income, but it has to be your primary weekly chore that you're doing is real estate investing. And a spouse can do this. So maybe you work full time and your spouse is a stay-at-home spouse. That spouse can qualify as a real estate professional by going and working over 750 hours a year in real estate. And that can be simply researching. That can be seeing properties. It can be taking care of your portfolio. It can be listening to podcasts, reading books on real estate, education, studying different markets. But you just have to catalog that on your calendar, that your spouse, okay, is now a real estate professional. And by her or him becoming a real estate professional, that includes you as a tax family if you're filing jointly. Okay. Again, these are all things to talk about with your CPA. When we talk to doctors and so forth at our company, when they book a call with us, very often doctors are completely unaware that their stay-at-home spouse could qualify as a real estate professional under the tax code. Okay. And the doctor that pays a boatload in taxes now can be saving hundreds of thousands of dollars in taxes by now having their spouse qualify as a real estate professional, because now their entire family has just altered their taxable income and the way in which they're able to file their taxes. So it's a game changer for dentists and other folks that make a lot of money in the medical profession that have a stay-at-home spouse, that they can qualify, even just getting a realtor's license and then spending that time. It's not like you're suddenly now having to go out and show properties on a Sunday. No, just even doing research, just understanding what being a real estate professional is all about can be a game changer for you and your family. So, Jag, yes, I would first make sure you have the right type of accountant, okay, a real estate accountant. And if you're buying our new construction properties, okay, you can qualify for all kinds of additional tax benefits because it's new construction. And you're able to write off those, you're accelerating that depreciation in this calendar year. through things called a cost segregation analysis. But again, you have to be a real estate professional to be able to take advantage of some of those things. I know this is a little complicated. It might be too complicated for a podcast right now, but we have full videos here on the channel. If you go to our YouTube channel or listen to the podcast, we have full videos on cost segregation analysis, qualifying for a real estate professional status with the IRS, and what things you can write off on your taxes. Those are all things that we have here on the channel. So please check those out. But Jag, if you're working with our team, speak with the person on our team that you're working with, and they will help you set you up successfully for those write-offs on those new construction properties. So some great questions today. Made me think a lot. Sorry, I was doing a lot of talking today, but we had some really good questions here. A little bit longer than I normally go on these shows, but some hopefully some useful information for all of you. Thanks to all of you for listening. You can leave us a voicemail question by going to morrisinvest.com/Clayton to drop us a question about real estate or financing, anything that's on your mind, and we will answer it here on the show. Now go out there, everyone. Take action. Become a real estate investor. I believe it's the #1 way to build wealth. We'll see you next time, everyone.